Welcome to the Recession Resistant Real Estate Radio. I'm your host, Brandon Cobb. Thanks for tuning in. And in today's episode, I want to touch on a question that I get a lot from investors, which is, when I give you money, where does it go? What do you use it for exactly? So that's what we're going to do. We're going to jump into the four main tranches that we put investor capital in when we're doing a deal, whether it's multifamily or new construction or land development, and how it's broken down, how it's used. So you're going to know exactly how this works by the end of this. But before we do, if you've been on the sidelines, if we've been having a one-way conversation and you've been interested in learning more about creating passive income from recession-resistant real estate, head on over to our website, hbgcapital.net, and schedule a call with us through the calendar. We look forward to getting to know you. Additionally, if you get value from these videos, please leave us a review and share them with your friends and family. All right, let's get started. So there are four main tranches that money goes into and what it's used for when you're doing any kind of development or syndication or buying a multifamily property. That first tranche is the down payment for the loan. So a lot of the value that comes from the creation of let's say it's a new construction development, is going to be actually building the development and creating the equity or the value at the end of it. In other words, what your cost is and how much of a equity cushion you have between that cost and what you can sell it for. So how does down payment work? Typically, what you do is you're putting a set aside amount of capital to go get more capital. So operators will take investor money, and if the bank is going to lend them $100,000, they might require a $15,000 down payment. Typically, we see banks requiring anything from no money down up to about 20%. When you get into land development stuff, it gets a little bit higher, some as high as 25, 30%. And it depends on the value of the current land and how much leverage there is. But that's what it's mainly used for tranche one. It is down payment money that goes to get more money from the bank to either buy the multifamily asset or construct the development or buy the land and develop the land. Tranche number two is capital expenditures. So if we're buying a multifamily unit, we probably have a value add plan to renovate the units, push the rents higher in the new units, and create the value and push the assets prices up to create the equity so everybody profits. If you're doing a new construction project, this capital expenditure would be the actual costs of the materials in the beginning of the project. So new construction is a little different, where a lot of the times there's startup capital that's needed. Banks will not give any of the money from the loan to purchase materials or get the project started. So in order to get that first draw from the bank, you at least need to have some work done. And to get that work done and those materials purchased, you need to raise some startup costs. So that second tranche is capital expenditure. It's also, startup costs and construction costs. That third tranche is, and arguably this one is, I don't see a lot of people doing this, and I don't know why, but having an interest escrow reserve set aside. So for us, on all of our development projects, we have multiple bank accounts set up under the newly formed LLC that we create with our investors. And one of those bank accounts is specifically for interest escrow. We want to make sure that we have a performing loan over the entire life of the project. I think the biggest mistake developers make, and especially the ones that go under, is they run into issues with the budget, they go over, or the time frame drags on, things get too expensive, they become illiquid, they can't make their payments, and the bank has to foreclose on them. The best way to make sure you have a performing loan is to go ahead and set aside the money in a separate account that the bank can pull from to make sure you're able to make all your payments to the life of that project. The next tranche is operational expenses. So this usually comes in the form of an acquisition fee or a GC fee or a management fee. So if you've ever seen a fee structure from a syndication, from an investor, This is mostly for operating capital. A lot of these projects take a while to get the money back out and the profits back out. And while that is being built and constructed, or the game plan or the pro forma is being acted upon, the person you're investing with, their company might need some money. They might need some money to keep operations going, to maintain salaries, to maintain their overhead. And you want to make sure that you have an operator who is financially strong and not going to go under, because if they do, they're not going to execute on the syndication or the asset that they have with you. So very important to make sure that your operator has the operational expenses on hand to be able to handle that. Another one I'm going to put on here that I didn't initially have, and it's baked into the capital expenditures, but you want a cushion in case you go over budget. As of the time of this recording, inflation is at historical highs. It hasn't been this high since the 70s. And as a result, there has been a dramatic increase in the cost of everything, but especially building materials. And there are multiple things that are affecting building materials, not only inflation, but the supply chain. People just cannot get materials. And when supply dwindles, prices go up. So having an extra cushion on hand, just in case you're not able to hit the budget, is very, very important. And I always tell investors, to ask that question: hey, in the event you go over budget, what's your game plan? Where is that money going to come from? A lot of syndications will have something written into the private placement memorandum that investors sign. And this is probably a big one that I see a lot of investors misunderstand, but it's a capital call. And in that capital call paragraph, it basically says, if this project runs out of money, you, the investor, are required to fulfill the difference in what you originally invested versus what is needed. So they could hit each investor up for, 20, 30, 40, 50,000, maybe even more per investor. And that's something you got to deal with. If you can't pay it, what they'll do a lot of times is go raise additional funds outside of the current investors that are in the syndication. And if they do that, it dilutes the investors' shares. So when you bring in more capital with the same amount of deal, you're going to have your shares diluted, which means potentially less returns on you. Something to cook on. Well, that's it. Those are the 5 things that your money is used for in a syndication deal. As always, if you're interested in setting up a call to learn more about recession-resistant real estate and how to build passive income from it, head on to our website, hbgcapital.net. Schedule a call with us. We look forward to getting to know you. Until next time.